Good evening. For those of you who don't know me, I'm Adam Rosenberg, Vice Chair of UJA's Rex Division. Welcome back to those who have tuned in before. If this is your first Rex Speaker Series or UJA event, welcome. We're so glad to have you here with us. This is now the fifth of our Rex Speaker Series, a string of events we've started since the pandemic began. Throughout this past year, Rex has been honored to hear from incredible leaders in the real estate industry, and we're excited to be here with two of them this evening, Howard and Michael Milstein. Before I give a formal introduction and kick off tonight's conversation, I want to call your attention to some of the incredible work of UJA during this time. As the spring season arrives, there's a sense we're finally emerging out of the darkness of the pandemic. But even with this hope, for so many New Yorkers, the return to normal won't be so easy. Yes, this year was hard on all of us, but for some it was harder. Holocaust survivors, the general elderly population, those already on the precipice of poverty, and those newly unemployed. They're dealing with hunger, unemployment, depression, and grief. And UJA has been there for them since the beginning of this crisis, and we plan to be there every step of the way. As many of you know, UJA has allocated over $65 million in emergency funding. These funds have focused on helping food pantries meet rising demands, getting the recently unemployed back to work, and providing much needed mental health services. None of us could have seen this pandemic coming and the needs that are arising from it. But at UJA, there was a promise to act at a moment's notice and do what it takes to get things done. This life-changing work is only made possible with your generosity, and we're so grateful. Thank you. I think I speak for many when I say this year has given us new clarity on what matters to us. And in this process, we've emerged stronger, more resilient, and a more connected community. I urge those listening in to this now to see this as an opportunity to get more involved with our Rex community or UJA and play a positive force in helping these communities who need your support. Please reach out to the email and the Zoom to get more involved. And now, without further ado, for the reason we're all here tonight, I'm excited to introduce our incredible speakers, Howard Milstein and Michael Milstein. Whether you've spent time under the blue whale at the Museum of Natural History's Milstein Hall of Science, taken classes at Columbia's Paul Milstein Center for Real Estate, enjoyed the Milstein Terrace and Reflecting Pool at Lincoln Center, or passed by one of the 50,000 apartments, 20 million square feet of office, 10,000 hotel rooms that Milstein Properties has developed or acquired over the past 100 years, the imprint that the Milstein family has left on New York City is undeniable. What originated about 100 years ago with a Russian Jewish immigrant establishing a flooring company in the 1920s has grown into one of the most influential real estate and philanthropic families in New York City's history. Tonight we hear from Howard and Michael Milstein, third and fourth generation leaders of Milstein Companies. During a diverse career, Howard has played an active role in the revitalization of Times Square in Battery Park City, bought Douglas Elliman in 1989 and rebuilt the brokerage and management firm into a market leader, created a utility company to challenge Time Warner's monopolistic practices, owned the New York Islanders, serves as executive chairman of the Nicklaus Companies, a joint venture with golf legend Jack Nicklaus, been at the forefront of fintech and prop tech investment, all while serving as chairman of Emigrant Savings Bank, the country's oldest and largest privately held family-owned bank, and heading Milstein Properties. Michael, who may have fewer years, is similarly accomplished, serving as co-founder and executive chairman of Company and Grand Central Tech, partner at Milstein Properties and New York Private Bank and Trust. Michael's also a founder and managing partner of Circle Ventures, the technology-focused venture arm of Milstein Companies. And after I thought I covered all bases, I found out that Michael also spent time as the CEO of Boylan Bottling, which, in my non-sponsored opinion, makes a fantastic root beer. All of these achievements are in addition to the family's philanthropic commitments, which go well beyond what I mentioned above. Again, Howard and Michael, thank you from UJA and the Real Estate Division for taking the time with us this evening. Hey guys. All right, so quick question, just starting off. What possibly goes on your business cards? I mean, are we saying these are double-sided business cards with all your business and philanthropic ventures, or is it like a different card per company? What goes on there?
What's a business card?
Fair.
Well, when we got into the banking business, David Rockefeller told my uncle, who was wondering, should the senior Milsteins have titles or shouldn't they have titles? And David Rockefeller told him the only important title is owner, and everyone knows you're the owner, so you don't need a title.
That's fair. So we're going to cover a lot of ground tonight. So let's dive right in. Howard, you have vast past experience dealing with different cycles, whether it was in the 1970s and your work within Times Square, your purchases in the 80s and 90s, including Douglas Elliman and kind of various other properties when people were really betting against the city. 2000, you were operating properties downtown. 2008, you were actively marketing properties. How are the impacts of COVID similar or different? And in general, what's your approach during downturns and in stronger markets?
Well, let me start with the general question. So in general, there are opportunities during downturns to buy real estate, in particular at distressed prices, because after all, real estate is an illiquid asset. So unlike stocks or bonds where, every minute of the day there's a bid and ask and it's microscopic, you can buy IBM at 100 and sell it at 100 and a quarter, or actually invert that. But basically the bid-ask spread is known as an active market, and you know what the price is. The real estate is what any willing buyer will pay a willing seller. And in these kinds of declines, the severe ones, and I'll address them in series in a second, there's a tremendous need for cash. People, they say cash is king in these situations, and nobody has cash. So if you have cash, you can buy stuff at tremendous discounts. So an example of that would be by 1974, the New York City was in a terrible economic and real estate recession. Things had been overbuilt. The city was verging on bankruptcy and skirted with it. And so things were bad. Well, my father, who was, of course, in retrospect, I didn't realize it at the time, but he was kind of a real estate genius, and he would figure out exactly when to buy. So in all these cycles that we'll talk about in the 70s and the 80s and the 90s, he always was buying at the bottom. So in the 70s, we bought the Roosevelt and the Biltmore hotels for a pittance out of the Penn Central bankruptcy. We also bought an abandoned building in Times Square called the Milford, it was that time called the Royal Manhattan. We reincarnated it as the Milford Plaza Hotel. Between the three of them, we had 3,000 hotel rooms in New York City, which caused my father and uncle to call me and say, we need you to join the business now. I was at an investment bank thinking my next stop would be a good idea to let my father and my uncle get a little older before I showed up. But in any event, so that's how I got drafted into the family in the decline of the 70s. But we got these great assets that within a year or a year and a half from the acquisition were worth, 4, 5, 6 times as much money as we had spent on them. Of course, we improved them and did other things with them. Then in the 80s, of course, the crash occurred in October of 87. But, things had been sort of shaky from the mid 80s on. And that led to the opportunity to save Emigrant Savings Bank and get into the banking business, which was one of the thoughts that I thought was worthwhile pursuing. And it came out to be true. But naturally, my father, after I had a strategy to buy a bank, which worked out with us owning a lot of small pieces of bigger banks that we all sold very profitably, but we didn't end up owning a bank. So my father one day called me in and said, you know, I've solved the problem. I figured out how to buy a bank. I said, well, which one what are you talking about? And he told me it was kind of a larger bank than I had in mind, and it was under regulatory supervisory control. So I said, well, that doesn't sound too good to me. That sounds like I'm going to have to go all over the country and look and bail out troubled loans. And I said, are you sure this is good? He said, don't worry, my friend Henry, his name was Henry Pierce, who was a great real estate broker in his day. My father did everything based on friends. And he said, Henry told me it's great. I said, well, it doesn't sound too good to me. Regulatory, said, don't worry about it. Well, lo and behold, it was great. There was never an asset quality problem. And so we bought that. There were other things that we bought in the 80s as well. We bought 4 buildings from a builder who had gone bankrupt. That include Claridge House on 87th Street and some others. So there are opportunities that come up in most severe downturns. Then in the 90s, we bought Douglas Elliman for nothing and built it up. But so basically, in this downturn, I'll skip ahead. Of course, 2008 was a huge downturn, and there was lots of money to be made buying almost anything at the bottom. But you have to know when the bottom is. But this COVID situation is a little different from a financial and investing point of view, because the decline was so rapid and the recovery was so relatively rapid. Just remember, I was talking about New York City getting into trouble in '74. We purchased those 3 hotels 4 years later in July of 70, in 2 separate transactions, July of 78. So usually it takes 3-4 years for things to hit rock bottom. We're only a year through it, and seem to be coming out of it. We'll talk about New York City's prospects, I'm sure, with a later question. But the time to buy is at the bottom when nobody else has cash and people have to raise cash. And that's not what's going on now. There's very little available. So it's actually quite different than prior recessions have been. Sorry for that long-winded answer to your question.
No, that was great. Michael, what has been the impact of COVID on your business holdings and as a corporate leader at the various companies you're involved in?
Well, I guess I'll start with the impact on a real estate business, because I'd imagine that is what most of the folks on this Zoom today will be most interested in. I'd say we don't have many hospitality holdings in New York City today, so I'll focus on kind of residential and commercial. On the residential side, we saw a massive kind of outflow of people moving out of the city during COVID. And, you know, occupancies in our buildings in terms of leased apartments took a real hit, dropping. You know, we were pretty agile in lowering prices, increasing concessions, but a lot of people just weren't renewing leases. And beyond that, so our occupancy dropped. We usually run occupancy at around 98%. We dropped kind of 85% and even below that for periods of time. And the nicer the building was, the higher the rent per square foot, the fewer people were actually in the building. So while in the nicer buildings, many people kept their leases, the occupancies of people actually inhabiting their apartments in some of our buildings were down as low as 30%, which was really an unbelievable number. And we were tracking that on a weekly basis. Fortunately, we've seen really within the last 6 weeks, leasing traffic increase, not just within our own portfolio, but within the portfolios of our friends who we talk to and kind of throughout the industry. So people are coming back to the city, people getting vaccinated, the weather getting good, everything that everyone's saying about kind of the roaring 20s. It seems like New York is going to be the epicenter of that, and people are coming back in droves. The office market is kind of a different question entirely. So in January, we completed the renovation of 335 Madison Avenue, which is our flagship office building. 1.1 million square feet connected underground to Grand Central. Really brought that to market kind of mid-January, and with like a completed lobby, et cetera, and had a few leases getting close to that we were getting close to signing term sheets on when COVID hit in March. We actually got one lease signed during COVID, and basically like the entire commercial office market, as those of you who are in that sector of the business will know, just hit the brakes. And so we had 3 term sheets in negotiation, all of which were put on indefinite hold, none of which have been revived to date. One of them was for the penthouse in the building. We're really fortunate that we've seen a lot of interest in the building from the very few tenants that seem to be in the market now. And we're signing we have a signed term sheet and are going to be signing a lease probably in the next couple of days on that same penthouse at a price of $20 to $25 a square foot less than what we were looking at pre-COVID. And we're looking at that. This is a building that we had emptied out in order to renovate and turn over. We'll have plenty of opportunity to make premium rents, but it's time to start really moving product. And the office leasing market there's been a lot of new construction. It was arguably overbuilt before the pandemic. And now you've got all of the large tenants really reconsidering what their office strategy is going to be. And large corporations, when it comes to their real estate strategy, are for the most part followers, not leaders. So you've got a lot of the tenants sitting on the sidelines, waiting to see what best practices become, how other companies want to accommodate their talent, whether partial remote becomes a thing, whether you can drive certain efficiencies in terms of the use of space. And I think we're really just at the beginning of companies starting to experiment with new office practices. And that's going to be, I think, an evolving story over the course of the next kind of 6 months to 3 years before it kind of settles out and companies really know how they're going to want to implement their office strategy.
So just continuing in that vein, Howard, what's your outlook on kind of on the upcoming quarter, on the next 3-5 years from a lending perspective, as far as volume, rates, terms? What type of changes are you seeing in the market?
Well, let's talk about the value in real estate. It's likely course over the next period of time. So you've got 2 different markets here. You've got the residential market and the office market. These are the principal large markets in New York. And on the residential side, we've now seen a very major turn, such that we expect to be back to full occupancy in our building at this 98% level by September or October at the current rate of leasing. And so as quickly as it went down, it seems to be coming up. As those occupancies go up, the amount of concessions will change and the price level will change. So what all that means is you'll have a healthy residential market kind of in a horse race with the commercial market. The reason I say that is, of course, most residential leases are 1-year terms. So people get to decide once a year do they want to leave. Commercial leases, on the other hand, are 10 years or 15 years. So somebody could decide, oh, I don't need all this office space, which can create some sublet space, but they can't do anything about it. The tenant is obligated on the lease. So from the landlord's point of view, you're going to get paid. If somebody's in the space, fine. If nobody's in the space, fine. You get paid. So assuming it's a good credit tenant. So there's a horse race between the readjustment that's going to happen in commercial use and occupancy. And what I mean by that is, the famous letters WFH, work from home. So work from home, somebody was saying on Squawk Box this morning, it was Jim Cramer saying, I don't know why they call it a WFH, because it's the same number of syllables as work from home. But it occurred to me that the reason is if you're texting somebody WFH is a lot faster than work from home. So basically that's where it's derived from. That's why they call it that. So, but the work from home, some people will have decided, and companies, that they don't need to be in New York City, that working just on this format that we're doing right now is adequate for what they need. Or they could decide, as it seems like Goldman Sachs and JP Morgan have decided, we want 100% of our people back in the office the same way they were before. And you'll have everything in the middle too. So there'll be some people who say maybe 1 or 2 days a week work from home, 3 days a week. And it'll be every combination from 1 and 4 one way to 1 and 4 the other way. And that, of course, means space that may be configured differently. So in the short term, where people have offices configured the way they are, it's going to be difficult for them to change their space usage. So this will be a rolling phenomenon. But I think that by 5 years from now, this will have settled down and people will know, well, what is the mix of private offices and open spaces and common offices that are not, people don't keep their personal effects in. That will all be sorted out. So over 5 years, you'll see that. But I do see a tremendous upward surge going on. And if our politicians don't foul it up too much, that will continue. What I mean by that is things like Amazon being rejected from its Long Island City location deal. I still can't shake my head about that one. But so that's what we see. We see now in terms of lending values and volumes, this is a time to continue to be very cautious. So, and our bank is always very cautious anyway. So what I mean by that is, does anyone really know if there will be a new strain of COVID that could be worse than the one that we're beating back now? Well, no, nobody really knows the answer to that. So it's going to take a while for prudent lenders to start raising their loan to value ratios and other things. At the same time, there's tremendous liquidity in the system. The trillions upon trillions that have been spent and will be spent mean that there's money everywhere, which has to be put to work. Eventually, it gets into the entities that invest this capital. And despite political efforts to minimize the attractiveness of investing capital by increasing the capital gains tax to, I think, a number like 43%, which is probably not going to work out too well for the economy if that happens. But despite that, you do have to put money out. So, a big asset class is real estate. And so there's going to be this tension between some people who want to be more prudent and are still thinking values could go down and they're waiting to buy for them. And the people who say, well, I just want to, keep moving here and say, I'll participate in whatever the risks are. Or as Chuck Prince once famously said about Citibank, what it should do before the last crash in 2008, when the music's playing, keep on dancing. That was his famous comment. And that didn't work out too well. So you've got a lot of cross currents. It's a little hard to know where they come out. The way I come out is New York will go through a transition, both on the residential side and office side. And 3 to 5 years from now, things will be back to the values, if not higher than they were when we started this before COVID hit in 2021. So, but, it is something that there will be opportunities, but I'm not sure what they are yet. Things are not trading way below their real value, that's for sure. And there really isn't an active market in people selling distressed real estate. So that's the overall view.
Oh, that was great. So in your opinion, kind of 5 years from now, even with ongoing or potentially ongoing work from home or hybrid, that office prices and office rents return to pre-pandemic levels, or that there's kind of going to be a global shift in how people work and how people live, and kind of there's going to be a full depression of market values?
So I believe that young people will be making up the part of the workforce that's working from home. In fact, more than make that up. Now, residential pricing will have to play a role in this because young people have to be able to afford to live in somewhere within proximity. So yes, I think that there will be a change in the mix of and the age mix of the people who are coming to offices. I mean, and one simple thought on it is, if you were 60 or 70 or even 50, you had to be much more concerned about your health in a COVID environment than a 30 or 40-year-old. Or certainly a 20-year-old. So I think that has people, that's dawned on people, especially the older people. Well, look, if we used to think it was great to be in the densest city in the world, there was great public transportation, there's all the museums, there's all the restaurants. Well, guess what? The restaurants were closed, the museums were closed, and you didn't want to be in a subway car with anybody else. So that became a minus. But it was a bigger minus for older people than younger people. And so the mix will change. But New York's still New York, and it'll all even out as we get down the next few years.
Yeah, I just jump in and add that with the possibility of people being able to have more flexible work schedules and maybe be in the office 3 or 4 days a week and work from home 1 or 2 days a week, I think you will see to some degree an exodus of families with children to more suburban locations, because today, if you would have to commute in 5 days a week, that's a very different proposition than commuting in 3 days a week. And if you have a family, there is a quality of life difference living in a house with a yard, and having some of the advantages of living in a neighborhood with other families that is not an urban center. So I think there will be a trend towards cities getting younger, the way my father was saying. And with that, I think you've got this interesting dynamic in office space where for a period of time, tenants are going to have a lot of leverage because there aren't going to be that many of them in the market. So tenants are really going to be pitting landlords against one another to compete for their tenancy and getting really, really great deals. And when you have an environment that, with large projects like Hudson Yards, still the World Trade Center development, and a lot of like the repurposed and rebuilt space in Midtown East all coming online at the same time. Essentially what you have is that space will be desirable and will be leased up. It just causes an issue for older, more commodity space as to how that space gets filled. And so I think a lot of the new projects, some of them weren't predicated on large enough margins and are gonna have to have some level of debt restructuring to be able to like reconcile with where the industry is pricing right now. But it's gonna be a real question as to what happens to the more commodity, like Class B, Class C office stock in less desirable locations. And whether that pricing is able to keep those buildings above water relative to their debt. And if it's not, if those buildings get taken back, if they get sold, and whether they're repurposed and stay in the office market, or if we see a wave of residential conversion and some neighborhoods that have traditionally been more commercial in nature becoming kind of new residential centers.
And do you see the residential demand being able to support future supply additions?
I think there always is and always will be residential demand in New York City. It's just who is that demand coming from, and what price can that population afford? So you've got kind of, as a residential landlord in New York City, you've got a population of young, single people who are ambitious and want to build careers. And there's no better place in the world to do that than New York City. And there won't be a better place to do that than New York City. And so, that isn't a group that can afford the nicest apartments that the super successful older, whether it's investment bankers, business builders, et cetera, can. And often those folks are forced, to live in less desirable areas. But that tendency will always be there. It's just a question of what price point it'll be there at.
And what the developer is able to underwrite. I mean, there's certainly a question about feasibility for conversion of commercial buildings to residential, it's not kind of a one size fits all proposition.
Well, it's just the basis at which those things get bought. If those buildings get taken back, what is the value of them? And, what are prospective buyers going to underwrite the value at, knowing the work that needs to put in to make it a cash flowing property, either as an office building or in a residential conversion.
Completely. Great. So just pivoting slightly. So for both Howard and Michael, philanthropy has been such a defining part of your family, and you've made such enormous positive impressions on the city. Why do you feel philanthropy is important, and how do you determine where to commit your time and resources? And since we are at a UJA event, if there's any UJA specific stories, feel free to sprinkle them in, but yeah, what's your general impressions?
Well, sure. Of course, I lived through the last, 70 years, so I was there for a lot of these things. And Michael's much newer to it, but it's a very high Jewish value of tzedakah. And while neither of my parents grew up in a wealthy home, far from it. However little they had, they always had what was called in Yiddish a pushki. So that's, if you have a penny, you put it in there for the poor people. Even though you were very poor yourself and couldn't afford anything, you always set aside something for the people who were needy. So that's a bedrock Jewish value. We all grew up with it. And of course, my grandfather, Morris Milstein, was very active supporting Jewish causes. So UJA and Federation, which were separate at the time, by the way, UJA taking care of Israel, Federation taking care of the communal activities in the New York area. And Einstein Medical College. And I remember when I first went to the office, when I was, 10 or something, there were all these plaques on the walls thanking the family for its generosity. And this was all things my grandfather would have supported. But keep in mind, that generation got to know each other nationally, of successful Jewish people who really started with nothing, but who identified with what was going on in World War II and identified with the need to create Israel. And so my grandfather used to tell me who the reliable people were in the different cities. I remember he told me about the Radner family in Cleveland. And of course, we do business with some of these people now. So it goes back a long time. So basically, it was that kind of philanthropy. But by the early 1960s, my grandfather realized that he wanted to have more of an outreach to the community. And we established the Morris and Rose Milstein Chair in surgery at Columbia Presbyterian, an unusual place for a Jewish family, but they were the best. So my grandfather decided that would be what we support. That ultimately resulted in my father and uncle basically running the board, giving the gift for the Milstein Hospital building, which had run into trouble. And so that kind of opened up the rest of the world for them. My grandfather's approach to philanthropy, which we still follow, is if you find what he called a saint, in other words, a person who's not interested in money for themselves at all. They're only interested in the betterment of mankind's position, the amelioration of disease and problems in the world. You find that person and they're part of a first-class institution and they come to you, you have to say yes. I don't spread this around too far, so a lot of people will be knocking on my door, and we've got enough of these. But basically, so people don't know when they meet with me that that's really the standard that I use, but that is the standard. And so therefore, it becomes very broad ranging, because you could be first class in education or in healthcare or in many other things. Over the years, of course, I added something to it, which is when my father and uncle really did business, but they didn't lead organizations. They didn't add their time and guidance and skills to the success of the charities, except at Columbia Presbyterian. But there have been many charities over the years that various members of my family, my mother, my wife, someday Michael, and other members, I have a brother and two sisters, have led. And, that's can be more valuable than the financial support. The story I was going to tell about UJA Federation, which was really UJA, was Larry Tisch, who the Tisch family has always been very real tremendous leaders at UJA Federation, called certain people, I think it was during the '67 war, and said he had gold in my ear, and we need to raise money so that we can win the '67 war, because there was a problem, big problem. And my recollection is that each of these 7 people gave $1 million in 1967, which was a lot of money in 1967,
Yeah.
much more than you would think. And so there were 7 Jewish families that did that were there, or with major money. And so, of course, eventually UJA and Federation came together. And that's worked out very well. There was a lot of skepticism about it. But, we have continued to support UJA Federation all these years, all these generations. It does great work, and it's been blessed with great leaders, both on the lay side, but especially on the professional side. And, Eric succeeded John Ruskay, and John was great. And Eric has really set a high standard for everything that he does. So Eric is somewhere in the audience. You might be blushing now, but what I'm saying is well deserved. He's made a real difference.
And Michael, how do you allocate your time on a philanthropic basis? I know you and your father are involved heavily with Cornell and Cornell Tech. You had mentioned a story about kind of a past UJA tech meeting as well. How do you figure out kind of where you're going to put your flag down?
The truth is, I consider myself obviously extremely fortunate in so many ways. And having seen the example my father has set, I really do believe that the largest impact he's been able to make is when he works with organizations where he invests his time in addition to his capital. And the reason his time is so valuable is because of his various range of experiences, network, expertise in building businesses. Because it's the classic teach a man to fish analogy, where, it's one thing to be able to give a one-time gift. It's another to be able to work with philanthropy to set up a recurring revenue stream that can help support that mission for the long term. A story of that is what my father did with the New York Blood Center, which when he joined the board and eventually became the chairman, was on a collision course for bankruptcy, even though the board at the time didn't realize it. And my father spearheaded essentially setting aside funds as an endowment, increasing revenues over time, such that when the revenue stream that the charity relied on completely disappeared as it was scheduled to, that organization would be able to continue in its mission of both like collecting and providing blood to New Yorkers in need for medical procedures, and also doing critical research that has helped save thousands of lives since then. And so my perspective really has been, as I've come of age in the business world, while my father spent so much time doing so much good, my focus has been on learning and gaining that experience in the business world, so that as I turn towards philanthropy in my career, I'll be able to bring more to the table than just capital. And so initially, it really has been, what are some areas of interest where I feel like I already have built certain levels of expertise? So in terms of helping create some programs with the folks at Cornell Tech in New York, that's an ecosystem that I've been involved in for a long time, and something that I was very passionate about. But I would imagine that over time, I'll feel more comfortable with my own skill set to be able to deliver value to the organizations that my family has historically supported, and that and to new ones that I will feel a passion for along the philosophy that my dad's mentioned. And certainly UJA is one that is incredibly dear to all of our hearts. And as I reflect upon it, we've obviously worked very hard as a family, but we've also been extremely fortunate. And we come from a community that has been persecuted for centuries. And I think being a member of a community that has gone through such difficult times, and I think, until proven otherwise, I think you have to, in being circumspect and cautious, imagine that the Jewish community will face difficult times again. Just because things are relatively good right now for some of us, that doesn't mean that it's time to forget about that community. That means it's time to double down and really make sure that we all come together and work as UJA does so well for the betterment of the Jewish people, the state of Israel, and really the New York community as a whole during times of need. So UJA is an incredibly special institution that we're very grateful to be able to support.
Thanks. That was really insightful. Appreciate both of your responses. We're now going to turn to a bit of a rapid fire round. Again, you guys cover a lot of ground and there is a significant amount of expertise here. So I'm going to throw out a few questions and kind of yes, no answers or one or two sentences. So just for a bit of a warm up, post-COVID trends, which are either temporary or permanent. We've kind of covered some of this already, but partial work from home, temporary or permanent.
Dad, do you want to go first?
Well, that's permanent. There's a definite change. I referenced it in what's going to happen to the haberdashery business. The next blow to the wearing of ties, that's because people won't be going to the office. And if they are, they're going to be more relaxed.
How about, so then Zoom, I'm assuming, is permanent also, or do other competitors?
I'm still a buy on Zoom.
I'll give a quick answer to that looks a little further out, which is I think both of those are permanent trends. And I think COVID is like the first minor disruption that precedes a major disruption. And the major disruption is going to be like the dual innovations around augmented reality and virtual reality in parallel with autonomous driving and electric vertical takeoff landing vehicles. I think those two innovations happening over the course of the next decade in parallel will drastically change not just the way people work, but the way people interact and the reasons why people want to seek to be together in person. And so if we think the telepresence that we can have via Zoom, which we're all experiencing right now, is compelling relative to what we experienced before the pandemic, new technologies are gonna 10 or 100x the efficacy of remote communications.
So that takes away my future of prop tech rapid fire question. But so just to follow up on that, what's the time horizon?
It'll be different in different places. I think with regards to, so that's when it comes to autonomous vehicles and EVTOL, because there are major regulatory hurdles there. It is at this point less a technology problem. The technology is being innovated upon, but there are major regulatory hurdles both at a federal level and at a state level. I think we'll see certain states like Florida, where you have kind of very business friendly state government and like a mayor in Miami who's courting as many tech companies as possible, be early initial adopters of this kind of thing, along with certain parts of Texas and Arizona. But I could imagine like electric vertical takeoff and landing vehicles flying from between Miami and Palm Beach, for example, within a 3 to 5 year time frame. I think building that infrastructure in New York will happen more within the 7 to 10 year time frame, based on the political environment. And same can be said for autonomous vehicles. where there actually is that, which is a harder technology problem because you're on a road with existing drivers, but is a technology problem that is in the process of being solved. In terms of augmented reality and virtual reality, I think the real first phase of mass user adoption will come in around 2024, which is when Apple is slated to release its augmented reality glasses. Facebook's working in parallel. Basically, you've got a dynamic where Facebook and the other companies that just exist as apps on somebody else's hardware device are now realizing that their entire business is dependent on someone else. And these giant companies really want to be self-sufficient. And that's why you see Facebook having acquired Oculus, having acquired incredible technology in companies like Control Labs, which is a very cool one that people should look up. You're going to have real competition between the behemoths who have unlimited funding for this purpose, driving to win the augmented reality and virtual reality game. That game is really going to kick off in about 2024. And we'll have the second and third version of those products by kind of 2026, 2027. And at that point, those products should be extremely compelling.
So piggybacking on that, with SPACs, kind of Compass raising valued at $7 billion, Lemonade 5.6, Hippo 5, View 1.6, Latch 1.5, and kind of many other non-SPAC significant raises. Is this a bubble? Are these valuations real or accurate? And kind of how do you personally find value or opportunity within tech?
Dad, do you want me to take that one?
Yeah, go ahead.
So to me, there are, just like with everything, there are different stories for each of these particular businesses. We were seed investors in Latch. We have tremendous confidence in the underlying economics of the business they're building. Is it a frothy environment and is it valued in a very healthy way? Absolutely. Are Luke and the team building something like incredibly special that really create an access platform across lots of categories of real estate? They are, and we think that's going to hold tremendous value. There are some other companies on the list you mentioned. I won't be specific as to which ones, but I'm actually trying to think. I think I was on a panel with the founder of one of them. In fact, I did this at UJA probably about 5 years ago. I was on a panel with Rob Refkin from Compass, and we had an exchange where I said, I just don't understand how it's a technology company. And he gave an answer that in 20 years, every company will be a technology company. And that didn't answer my question as to why Compass should be valued the way a technology company is. I still haven't gotten an answer to that question that satisfies me, or even an answer to that question. And, if Rob's able to build that into a great business that drives returns for its investors, I have many friends who are involved. I'll be thrilled for all of them. That's one where I take a little bit more of a skeptical outlook. But in this frothy environment, you're seeing the way I kind of break it down is there are a ton of SPAC vehicles out there. Using ballpark numbers, I'd say only 30% of them will really be able to do justifiable deals in any way, shape, or form, just because there's so much capital sitting out there. Of that 30%, I think only 30% of the deals will be good deals. Yeah. So that basically means of all the SPACs being raised, 9% of them will do deals that should get done. And the rest will be a combination of SPACs that don't find deals and SPACs that do deals that should not happen. So for those 9%, investors will do very well and it'll be an excellent thing. For the deals that do get done, it could be great for the founders and employees of the company, and institutional investors may get taken for a ride when the company isn't able to deliver the results over time that the forward projections had promised. Or if this frothy environment pops and multiples come down, which could happen if interest rates rise or something like that. So,
no, that's That's great, and kind of leads to the next question. And so we're a little short on time. I'm just going to run through a few, and we'll see what we get to. But it's been really great so far. Howard, does inflation still exist?
Yes, inflation exists. If you go to Whole Foods, it exists a lot. If you look at the overall averages, you don't see it. One of the reasons for that is you don't get the home prices in the cost of living index. You get rental equivalents. And so while the price of housing has been going up, rent levels have not been going up at the same rate. And so the cost of housing has actually been understated. Keep in mind that economists are like weathermen, paid to be right half of the time, and they can't be right more than half the time. So they don't expect them to be right more than half the time. And the reason is their methodology. So what they do is they try to recreate in a computer model what will actually happen in the economy. And there are many variables in the economy. One of them is something called a consumption function, which means what is the propensity of a person who gets an extra dollar, what is his propensity to spend that dollar? How much of it will be saved? How much will be spent? Because you can get more money to people, but the question is how much gets spent, which leads to GDP growth. So these are complicated. So when you know, and I found this out when I started studying economics at the intermediate level, that when you find out that there are dozens of functions like the consumption function, and the consumption function alone had 148 variables in it. So you're going to multiply dozens of variables times each other with, of these 148 variables, some are subjective. So there's just no way this can be right. So that's why economists are never right. So they can't be right. The way they do it prohibits it from being right. So basically, but you can understand general economic principles, supply and demand, et cetera. And you can understand that if you're printing a lot of money, that by definition, there's going to be inflation because you've got more dollars chasing the same amount of goods and services, more or less. And certainly, that's what's happened here. So yes, there is some massive inflation coming at some point. Now, that's in the context of globalization. So why has there been no inflation to speak of for the last 10, 15, 20 years, basically since the Clintons? Because if you can, pay someone $1 to make something that used to cost $15 to make, that's cheap. So this has led to the current political schism that we have, which is everyone since the Clintons on the Democratic side was making the argument, and the Republicans too, that, well, if it's cheaper for all consumers, on average, it's good for Americans, except that led to 20 million Americans who were blue collar workers losing their jobs and basically making less money now than they made 15 or 20 years ago in real dollars. So it's been a disaster for them. And that's why you've had the political upheaval. And the next political upheaval can come from lots of places. But I think you do need to look beyond what the strict parameters of the economy in terms of what stability in the markets will be, because there's such a political maelstrom going on now, and nobody knows how it's going to work out. But there will be more inflation coming down the road.
So just the last question, because we do want to end around 6:30 or so, but if you could give one piece of advice to New York's future mayor, what would it be?
Pay attention to common sense and what the business world needs to succeed. Because if you alienate the business world and the business people, you've killed the goose that lays the golden egg, and then everybody else will be looking at each other and saying, well, how are we going to cash in these food stamps? And there'll be no money to pay for it. So in the end, there has to be sound fiscal operations. The taxes can't be too much of a penalty. And there's a real risk that New York does go in the wrong direction on this, but I'm hoping that sanity will prevail and that there will be a hospitable atmosphere for business. Not that it should be a giveaway in any sense, but just positive, as opposed to business is the enemy, which a lot of people seem to have adopted more recently.
I'd just also add focus on the basics of making New York a great place to live and work, which during COVID in some ways eroded. So by that, I mean sanitation, I mean crime, and the things that make New York, New York. So to me, the exodus of talent and the shuttering of businesses within our hospitality sector are a big hole that we're going to have to dig ourselves out of as a city. The hospitality industry is something that really makes New York one of the most special places to live, to visit in the world. And so, I mean, the baseline stuff, it's looking at where were we before COVID? And there are some ways in which New York, even if COVID fully disappeared and with vaccinations, for many people, that's becoming a reality. There are ways in which New York City is a discernibly worse place to live, to work, to visit than it was pre-COVID. And the first order of business is just righting that ship, getting back to where we were, and hopefully exceeding it on those very basic fronts.
Completely agree. Howard and Michael, really thank you for your time. Your really insightful words. It was fantastic. Kind of on behalf of UJA and the real estate division, we really appreciate you guys taking the time. And then before we leave, I do want to announce an exciting upcoming event. Please join us for our virtual annual real estate luncheon honoring Jonathan Estrich, founder and CEO of Estrich & Company, on June 2nd at 12 p.m. Eastern Standard Time. And we'll put a link in shortly, great, for that event. And thank you to everyone for tuning in. And we, again, Howard and Michael, thank you. This was
Thanks,
great.
Adam. Thank you, everyone.
Thanks, Adam.